They did ask that we might start off with talking about sort of what got us here. And it's pretty simple in my case. It's not IQ. I'm sure you'll all be glad to hear that. But everybody in this room has more IQ than they need to do my job. The big thing is rationality. And in other words, I always look at IQ and talent as sort of representing the horsepower of the motor, but then in terms of the output, the efficiency with which the motor works, that depends on rationality, because a lot of people start out with 400 horsepower motors and get 100 horsepower of output, and it's way better to have a 200 horsepower motor and get it all into output. And so why do smart people do things that interfere with really getting the output they're entitled to? And it gets into habits, into character, into temperament, and it really gets into behaving in a rational manner. It's not getting in your own way. As I say, everybody here has the ability absolutely to do anything I do and much beyond. And some of you will and some of you won't. But it will, the ones that won't, it will be because you get in your own way. It won't because the world doesn't allow you to. It will be because you don't allow yourself to. I look for businesses where I think I can see what they're going to look like in 10 or 15 or 20 years. We don't own any, but if you take Wrigley's chewing gum, I don't think the internet's going to affect how people chew gum. And Bill probably does. I mean, but I don't think it's going to affect the fact that Coke will be the drink of preference and will gain in per capita consumption around the world. I don't think it'll change whether people shave or how they shave, or the fact that they like a better shaving system, as the Mach 3 is going to be very shortly, I might add. So we are looking for the very predictable, and you won't find the very predictable in what Bill does. You'll find the more exciting things, the things that are going to change society more. And so I have a little different opinion. As a member of society, I applaud what he's doing, and as an investor, I keep a wary eye on it. And that's, it's a different approach to investing. Most people think of that all as opportunity, and it has been opportunity. Every internet stock has gone crazy here in recent months, but I don't know how to look at one or the other and tell the winners. I think just jumping in the pool, basically. I mean, I've always enjoyed what I've done, and a few things have worked out very well. And the nice thing about the investment business is that you don't need very many. But you'll see plenty of times when you get chances to do things that just shout at you. And the thing you have to do is when that happens, you have to take a big swing. I mean, that is no time to be reading a book on the theory of diversification. I mean, that is a time to put very significant. When you find something where you know the business, it's within your circle of competence, you understand it, the price is right, the people are right, then you take your thumb out of your mouth and you barrel in.
We were talking at breakfast this morning about of all Warren's investments decisions, which was the worst decision? Which it's amazing, and they're tough to find because he's the track record's unbelievable. But we, I think, decided that by some metric, buying the company that his company is named after was probably the worst investment decision.
That's true. I mean, we went into a terrible business because it was cheap, and it's what I refer to as the used cigar butt approach to investing. You know, that you see the cigar butt down there, it's soggy, it's terrible, but there is one puff in it and it's free. And that's what Berkshire was when we bought it. I mean, it was selling below working capital. Actually, buying Berkshire Hathaway, buying control of it, was probably the biggest single bad decision that I've made. And then I made all kinds of decisions that have cost us billions of dollars, but they've been mistakes of omission rather than commission. I mean, there were businesses that we knew enough to buy a lot of. I don't worry about not buying Microsoft because I didn't understand that business. I didn't understand Intel. But there were businesses that I did understand. Fannie Mae was one. I mean, I made a decision to buy it, and I didn't execute. And we would have made many billions of dollars on something that was within my circle of competence, and I didn't do it. And you don't see that. Conventional accounting doesn't record that. But believe me, it happened. Ben Graham used the example of Mr. Market, which is and we've used it. I've copied it in the report. I copy from all the good writers. And Ben said, just imagine that when you buy a stock that in effect, you've bought into a business where you have this obliging partner who comes around every day and offers you a price at which you'll either buy or sell, and the price is identical. And no one ever gets that in a private business where daily you get a buy-sell offer by a party. But in the stock market, you get it. That's a huge advantage. And it's a bigger advantage if this partner of yours is a heavy drinking manic depressive.
Go ahead, sir.
Hi, I'm Kasim Tavalali, senior in SFS. I was wondering if you have any stock tips for any of the students. We're all trying to make a little living.
I didn't think they taught that at Georgetown. The best investment I ever made. Well, I bought a book in 1949 by a fellow named Ben Graham called The Intelligent Investor. I don't remember what I paid. But aside from what I paid for my 2 marriage licenses, that was the best investment I ever made. It's very important to have the right framework. You need to have an approach to investing that's sound. And Graham's approach is simple, but some people adopt to it, and which I did immediately, and most people don't. But if you have the right philosophy, you will find opportunities as you go through the next 20, 30, 40, 50 years. And frankly, you're most likely to find them when in periods.
What would you think is the most important thing, the key in evaluating a company? I'm not asking about doing mediocre, I'm not asking about being average, but about excellent, remarkable. Just name one thing.
The most important thing is to be able to define which ones you can come to an intelligent decision on and which ones are beyond your capacity to evaluate. You don't have to be right about thousands and thousands and thousands of companies. You only have to be right about a couple. I met Bill Gates on July 5th, 1991. We were out in Seattle, and Bill said, "You've got to have a computer." And I said, "Why?" And he said, "You can do your income tax on it." I said, "I don't have any income. Berkshire doesn't pay a dividend." He said, "Well, you can keep track of your portfolio." And I said, "I only have one stock." I said, and he says, "It's going to change everything." And I said, "Well, will it change whether people chew gum?" And he said, "Well, probably not." And I said, "Well, will it change what kind of gum they chew?" And not. And I said, "Well, then I'll stick to chewing gum and you stick to computers." I don't have to understand all kinds of business. There's all kinds of business I don't understand. But there's thousands of opportunities there. I did understand the Bank of America, and I'll be able. I'm able to do that. I'm able to understand some given percentage. But Ted Williams wrote a book called The Science of Hitting, and in The Science of Hitting, he's got a diagram, shows him at the plate, and he's got the strike zone divided into 77 squares, each the size of a baseball. And he says, if I only swing at pitches in my sweet zone, which he shows there, and he has what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. Now, he was at a disadvantage because if the count was 0-2 or 1-2 or so on, even if that ball was down where he was only going to bat 230, he had to swing at it. In investing, there's no called strikes. People can throw Microsoft at me and you name it, any stock, General Motors, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day, and only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike. But it's an enormously advantageous game. And it's a terrible mistake to think you have to have an opinion on everything. You only have to have an opinion on a few things. In fact, I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time. So I don't worry too much about the things I don't understand. If you understand some of these businesses that are coming along and can spot things on, if you can spot on Amazon, for example, I mean, it's a tremendous accomplishment what Jeff Bezos has done. And I tip my hat to him. He's a wonderful businessman. He's a good guy, too. But could I have anticipated that he would be the success and 10 others wouldn't be? I'm not good enough to do that. But fortunately, I don't have to. I don't have to form an opinion on Amazon. And I did form an opinion on the Bank of America, and I've formed an opinion on Coca-Cola. I mean, Coca-Cola's been around since 1886. There's 1.8 billion 8-ounce servings of Coca-Cola products sold every day. Now, if you take 1 penny and get 1 penny extra, that's $18 million a day. And 18 million times 365 is 7 billion, 3 less 730 billion, or $6,570,000,000. So annually, $6,570,000,000 from 1 penny. Do you think Coca-Cola is worth a penny more than Joe's Cola? I think so. So, and I've got about 127 years of history that would indicate it. So those are the kind of decisions I like to make. And you may have an entirely different field of expertise than I would have, and probably much more up to date in terms of the kind of businesses that we're seeing evolve. And you can get very rich if you just understand a few of them and understand their future. But fortunately, I don't have to. I mean, if we go into Heinz, and I look at people pouring ketchup on, hamburgers and potatoes. I don't think it's going to change. And the nice thing about it, some products travel, some products don't travel. Candy bars don't travel well. I mean, if you look at the Cadbury bars in England, they don't sell well here. And if you look at the Hershey bars here, they don't sell as well someplace else. Soft drinks travel, and ketchup travels. I like products that travel.
Defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, said in his book, he said, "I'm no genius," he said, "but I'm smart in spots, and I stay around those spots." And that is the key. So if I understand a few things and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, the stocks are going up and everything, they start fooling around someplace else, eventually I'll get creamed, and I should. Well, intrinsic value is what is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock. You know, you can gamble in the stock if you want to, or your neighbors can buy it. But if you don't answer that question, and I can't answer that for internet companies, for example. There are a lot of companies, there are all kinds of companies I can't answer it for, but I just stay away from those. Number two.
So you got formulas involved in finding intrinsic values on certain companies. I mean, you've got a mathematical system set up.
Discounted present value of future cash, yeah.
Okay. Second short question is, why haven't you written down your set of formulas or your strategies in written form so you can share it with everyone else?
Well, I think I actually have written about that. If you read the annual reports over the recent years, in fact, the most recent annual report, I use what I've just been talking about. I use the illustration of Aesop. Because here Aesop was in 600 BC. Smart man, wasn't smart enough to know it was 600 BC, though. I mean, would take a little foresight. But Aesop, you know, in between tortoises and hares and all these other things, he found time to write about, you know, birds. And he said, a bird in the hand is worth two in the bush. Now, that isn't quite complete, because the question is, how sure are you that there are two in the bush? And how long do you have to wait to get them out? Now, he probably knew that, but he just didn't have time because he had all these other proverbs to write and had to get on with it. So, but he was halfway there in 600 BC. That's all there is to investing, is how many birds are in the bush, when are you going to get them out, and how sure are you? Now, if interest rates are 15%, roughly, you've got to get two birds out of the bush in 5 years to equal the bird in the hand. But if interest rates are 3%, and you can get two birds out in 20 years, it still makes sense to give up the bird in the hand, because it all gets back to discounting against an interest rate. Problem is, often you don't know, not only how many birds are in the bush, but in the case of the internet companies, there weren't any birds in the bush. But they still take the bird that you give them if in the hand. But I actually have written about this sort of thing, and stealing heavily from Aesop, who wrote it some 2,600 years ago, but I've been behind on my reading. But the biggest mistakes we've made by far, I've made, not we've made, biggest mistakes I've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. They don't show up anyplace. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago, or close to it, when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. And I don't worry about that if it's Microsoft, because I don't know it. Microsoft isn't in my circle of competence. And so I don't have any reason to think I'm entitled to make money out of Microsoft or out of cocoa beans or whatever. But I did know enough to understand Fannie Mae, and I blew it. And that never shows up under conventional accounting. But I know the cost of it. I know. I passed it up. And those are the big, big mistakes. And I've had plenty of them. And unless I tell you about them in the annual report, and I resist the temptation sometimes. Unless I tell you about them in the annual report, you're not going to know it because it doesn't show up under conventional accounting. But omission is way bigger than commission. There's big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it, and every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company you didn't even understand what they did or couldn't pronounce the name, but they'd made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. It's easier now than ever because you can do it online. Just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one in the rest of your life. You would think a long time before every investment decision, and you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to. You can detach yourself temperamentally from the crowd, you get very rich. And you won't have to be very bright. I mean, I'm sure you are, but you want, it doesn't take brains. It takes temperament. It takes the ability to sit there and look at something. When I started out in 1950, I would go through and find things at 2 times earnings, and they were perfectly decent businesses, and people wanted jobs at those companies, and everybody knew they were going to be around, and they wouldn't buy them at 2 times earnings, and that's when interest rates were 2.5%. I started selling securities when I was 21. And a Kansas City life insurance company happened to be a fairly prominent company in Omaha. And the policies they sold you, if you were buying life insurance from them, had a built-in assumption of 2% interest. The stock of Kansas City Life was selling at less than 3 times earnings. You were getting 35% if you bought the stock. No question about the soundness of the company. I went to the local agent. I figured, hell, I ought to be able to sell him a few shares of stock. I mean, the guy ought to understand it. I mean, he's got his whole life invested in this company. I went to the local agent who'd been with him for 20 years, and his name was Moose. And I said, Mr. Moose, I said, you're selling these policies with 2%. You may even have a few members of your own family, and you can buy into this company whose paycheck you depend on every month, and whose future your beneficiaries of these life policies depend on, and who you're selling them, a 2% investment on, and you can get 35% on your money. He said, stocks aren't any good, and I couldn't sell you. I was a lousy salesman. I mean, well, you have to start with that, but it just blew me away. It blew me away. I thought sometimes I used to wonder if I was nuts, but those things, the same thing happened. I mean, in 1964, the Dow closed at 864. At the end of 1981, 17 years later, it closed at 865. It moved 1 point in 17 years. Now, that's not a big move. And that, you can't believe how discouraged people were during that period. But, people were living better. So things can go on a long time that don't make sense. But they do come to an end. I mean, the internet thing. I mean, you had these companies selling for many billions of dollars that had practically no prospects of making any money. That's a bubble.
But there's 2 kinds of items that people buy and think they're investing. One really is investing and the other isn't. If you buy something, a farm, an apartment house, or an interest in a business, and look to the asset itself to determine whether you've done something, what the farm produces, what the business earns, and so on. You don't really care whether the stock market's open. You can do that on a private basis. In fact, you do it on a private basis if you buy a farm or apartment house generally. And it's a perfectly satisfactory investment. You look at the investment itself to deliver the return to you. Now, if you buy something like Bitcoin or some cryptocurrency, you don't have anything that's producing anything. You're just hoping the next guy pays more. And you only feel you'll find the next guy to pay more if he thinks he's going to find somebody that's going to pay more. Now, if you ban trading in farms, you could still buy farms and have a perfectly decent investment. If you ban trading in apartment houses or even in equities, if you ban trading in Berkshire Hathaway for the next 5 years, our investors would do fine, over time. But if you ban trading in tulip bulbs, or if you ban trading in some Bitcoin, which nobody knows exactly what it is, people would say, well, why in the world would I buy it? Yeah. And you aren't investing when you do that. You're speculating. There's nothing wrong with it. If you want to gamble, somebody else will come along and pay you more money tomorrow. That's one kind of game. That is not investing.
Scott from Papillion, Nebraska says, how do you tell the difference between reasonable and unreasonable fear? So in other words, the stock's down, maybe it should be down, or a stock's down, maybe it shouldn't be down.
Well, you just keep looking at the facts. I mean, you're looking at a business. That's the important thing. You don't look at a stock chart. I looked at stock charts for years. I used to have a lot of fun doing that. I was kind of groping around for a philosophy. You look at the business. I mean, how do you decide if you own a half interest with some buddy of yours in a McDonald's store? How do you decide, whether it's a successful investment? Well, if the snow's 2 feet out and there's no business today, do you say, well, I made a terrible deal? No, you look at how it's performing as a business over time, how it's doing versus the competition.